Most people want to start investing, especially when they hear things like stocks, mutual funds, or ETFs. But the problem is, almost nobody explains it in a simple way. So, what happens? People get confused, they delay investing, or they just randomly put money somewhere without understanding it. In this video, I'm gonna fix that. I'll explain everything step by step in the simplest way possible, like I'm explaining to someone who has never heard about investing before. By the end of this video, you will clearly understand how investing works, what mutual funds, stocks, and ETFs are, and how a beginner should actually start. So let's begin from absolute zero. First, let's understand the most basic question. What is investing? Investing simply means putting your money into something with the expectation that it will grow over time. For example, instead of just keeping your money in a savings account, you use it in a way that helps it increase in value. This is important because money sitting idle actually loses value over time due to inflation. So, investing is basically a way to protect and grow your money at the same time. It's not about getting rich overnight, it is about long term patience and dedication. Think of it like planting a tree. You don't get the rewards and fruits immediately, but over time it grows and gives returns. That's exactly how investing works. Now, the question is, why do people even invest? There are three main reasons. First, people invest their money to grow over time. Instead of money staying the same, it increases. Second, they invest to beat inflation. Inflation means prices of things going up every year. So your money needs to grow faster than that. And third, people invest to build long term wealth. Things like buying a house, retirement, or financial freedom all depend on investing. So, investing is not optional in the long run. It is actually necessary if you want your money to grow in real value. Now, let's talk about the main ways people invest. There are three basic options every beginner should know: stocks, mutual funds, and ETFs. These three are the foundation of most investing in the world. The important thing is you don't need to understand everything at once. You just need a basic idea of how each one works so you can decide which fits you as a beginner. So let's break them down one by one in a very simple way. Let's start with stocks. When you buy a company, you're basically buying a small ownership part of a company. So if the company performs well and grows, the value of your stock increases too. For example, if a company earns more profit, expands, or becomes popular, its stock price usually goes up. But stocks also come with risk. The price can go up and down very quickly depending on news, market conditions, or company performance. So, stocks can give high returns, but they also require knowledge, patience, and risk tolerance. This is why beginners should be careful and not invest blindly in stocks. Now let's move to mutual funds, which are one of the most popular options for beginners. In a mutual fund, many investors pool their money together. This pooled money is then managed by a professional fund manager. The manager decides where to invest, usually in a mix of stocks, bonds, and other assets. The biggest advantage is that you don't need to pick individual stocks yourself. This makes it much easier and less stressful for beginners. Also, mutual funds are usually diversified, which means your money is spread across many companies, including reducing risk. So instead of depending on one company, you are investing in many at the same time. Next are ETFs or exchange traded funds. ETFs are similar to mutual funds because they also contain a group of different stocks or assets. But the difference is that ETFs are traded like normal stocks on the stock market. This means that you can buy or sell them anytime during market hours. ETFs are usually low cost and very transparent because they often track a specific index like the Nifty 50 or S&P 500 or the Sensex 30. For beginners, ETFs are a very simple and efficient way to start investing without taking too much risk. Now let's quickly compare the risk of each one. Stocks are the highest risk, but they also have the highest potential return. Mutual funds are medium risk because they are diversified and professionally managed. ETFs are usually lower cost and more stable, especially index based ETFs. So the basic idea is simple. Higher risk can give higher returns, but also higher chances of loss. And lower risk give more stability but slower growth. Every investor needs to find a balance based on their comfort level. So, how should a beginner actually start investing? First, don't rush into anything. Spend time learning the basics. Second, start small. You don't need a lot of money to begin investing. Even small amounts are enough to learn how the market works. Third, choose simple options like mutual funds or ETFs instead of jumping straight into risky stocks. And fourth, stay consistent, stay disciplined. Investing isn't about quick money, it's about long term consistency and hard work. If you stay consistent for years, that is where real growth happens. The most important thing to understand is this: time is more powerful than money when it comes to investing. You don't need a huge amount to start. What matters more is starting early and staying consistent. Even small investment, if done regularly, can grow significantly over time. So instead of waiting for the perfect time, the best time to start is now. If you found this video helpful, I make simple finance content just like this. I explain topics like stocks, mutual funds, ETFs, and personal finance in a very easy way. No confusion, no complicated terms, just clear and beginner friendly explanation. So if you want to understand money better and improve your financial knowledge, make sure to subscribe to the channel. It'll help me out a lot, and I'll see you in the next video. Bye.